All right. All right. Tonight we're going to kind of look at, not kind of look at, we are going to look at how gaps with candlestick signals are very effective. And the reason I like this presentation is that most professional investment advisors tell their clients to stay away from gaps because you don't know what's going on when prices gap. And that's the biggest bunch of malarkey. Candlestick signals in conjunction with gaps will make you tons of money. And it's not difficult. If you keep putting common sense investment analysis to a chart, basically you're kind of controlling which direction, or not which direction, but analyzing not only which direction a price is going to move, but what force it's going to move in that direction. And that's exactly what candlestick analysis does when you incorporate gaps into it. So what we're essentially going to do is just kind of learn the simple logic that's incorporated into a gap. Get ready or be prepared for the big price moves based upon the location of that gap, and see how to identify when it's time to take profits at the correct level. So, all right, once again, you don't have to take notes. Just kind of sit back. All this stuff will be available to everybody. 85% or more positive trades is a Ponzi scheme. All right, that's one way to look at it. All right, so a gap is basically, in Japanese analysis, they call them windows. And that's when the price from one day, and I'll use the day charts or the daily as a time frame. But the gaps work on any time frame. The reason they don't work as well during a rolling information like during the day is because usually you don't have gaps from one price to the next. It's all kind of a smooth rolling. But whenever you have a definite time frame, such as a daily market open, and you start the next day, you're going to get gaps. And gaps are essentially the price rising, or on a bullish gap rising above any of the previous day's trading range and gapping it above it and not coming back in and filling that into that range. And so if you just look at it on a common sense basis, what does that mean? That means from one day to the next, the enthusiasm to get into that position was so great that they gapped it way up above any of the previous day's trading, which is a message right there by itself that people want to get into that position with great enthusiasm, which is exactly what you're looking for if you're seeing a candlestick buy signal, excuse me, especially in an oversold condition, and the uptrend is starting with an uptrend, with a gap starting the uptrend, showing great enthusiasm. Guess I better test this. Can everybody hear me all right? We're going to go through the simple stage tonight, but even the simple stage is going to give everybody more opportunities to make big profits than they'll ever have a chance to cash in on. So the four basic gaps is a gap up at the top of a trend, uptrend, and then a gap up. At the end of a trend, you have a candlestick signal and then a gap down. Or in an oversold condition, you've got a candlestick signal followed by a gap up. That's the one where we can make tons of money. And in a downtrend, downtrend until they gap it down. And then again, this comes right back to what the Japanese race traders kind of educate us on, is where do most people sell? They panic sell at the bottom. And that's usually illustrated by that gap down. Still no sound, and no chart. Jim, can you help these folks, somehow? All right. So, now what's the difference between these gaps? Two of these gaps show force. And that's basically the, candlestick signal in the oversold area followed by a gap up. That's showing you a new force has come into the trend. Or if you see a candlestick sell signal in the overbought condition and they gap it down, that tells you the force is strong. They're going to push that price down enthusiastically. The other two are exhaustion. Two of those signals show exhaustion, especially when their Japanese race traders say, where do most people buy? They buy exuberantly at the top. And when they gap it up at the top of a trend, that's usually the exhaustion. You start looking for a sell signal. Correct, Alan. You wouldn't get gaps in things that trade for, constantly for 24 hours. Let's see. All right. Let's see. And then the other one is you're in a downtrend, and then they gap it down. That's the exhaustion. That's everybody just panic selling at the bottom. So with gaps, we should easily be able to see when it's time to buy based on a gap up in an oversold condition. And when it's time to take profits, when we see a gap up in an overbought condition, that tells you that's the last of the enthusiasm. So let's go through these one at a time. First of all, when we see a gap up in the overbought condition, that's essentially the ultimate of that enthusiasm, of buying in the enthusiastic buying or exuberance at the top. Now, for some of you new folks, the chart we have is very simple. On this chart, we don't see the red one, but the big, thick red line is the simple 200-day moving average. The blue one is the 50-day moving average, simple moving average. The gray is your 20-day simple moving average. Those are all simple moving averages because every money manager in the world makes their decisions based upon those moving averages. The advantage we have with candlestick signals is we can see exactly what's going on in investor sentiment at those levels where there's a lot of decisions making going on. Now, the one that is make you tons of money is the T-line, the 8 exponential moving average, which has a very simple trading technique. But if you see a candlestick buy signal and a close above the T-line, you can stay in this trend until you see a candlestick sell signal and a close back below the T-line. The moving averages are the 200, which is the red one is not on here right now, the 50-day moving average, and the 20-day simple moving averages. Then the black one is your 8 exponential moving average known as the T-line. Now there's one caveat to the T-line, is that as long as you stay above the T-line and don't see a sell signal, you can stay in that trend, unless you see it move away from the T-line. The further away you move from the T-line, especially in the overbought condition, the higher the probability you're going to come back and test it. So why take that chance? If you see a candlestick sell signal, first of all, the sell signal is your first and most important element as far as when to get in and get out of a trade. So if I see a doji in the overbought condition after a gap up away from the T-line, what's the simple rule of a doji? If they open it lower the next day, you close out the position immediately. That's more, exemplified here because the further away you are from the T-line, the higher the probability of this reversal signal is going to be in place. Worst case scenario is it moves back to the T-line. We don't know whether it's going to bounce up where you can buy it back or whether it's going to continue on down. We just want to take our profits when the chart tells us it's time to take profits. Yeah, that's a spinning top or a doji. They both represent the same thing. Indecision between the bulls and the bears. Okay. For some reason, this mouse is acting up tonight. Just when you need it to. All right. So, when you see a gap up in an overbought condition, start looking to take profits. Again, the further you are from the T-line, the more important it is that if they open it lower the next day, you close out the position. Again, that gap up doji in the overbought condition, it's time to start looking for a sell signal. It may come back and support on the T-line. You can always buy it back. But the probability say it's time to take profits. There is a 3 T-line, which we'll get into some night soon, using that as a faster indicator for getting in and out of positions. Now, if you're buying, come on, where'd it go? We know all the simple rules of our buying, that if we see a buy signal and a close above the T-line, you stay with it as long as it stays above the T-line. We also know that we can use the 50-day moving average. That the simple rule is that if it comes up through a resistance level, it'll usually come back and use that resistance level as support. If it does, as we can see in this left-right combo, that we're still in an uptrend, if they're stretching it in an overbought condition right to another resistance level, especially if they gap it up and do a candlestick signal, that's going to give you that much more evidence that it's time to start taking profits, because they had to stretch to get here. And where do you think everybody buying down here was going to take their first profits? Probably when it got to the 200-day moving average. So this is where you want to be ready, that if you see that gap up in the overbought condition, spinning top, doji, whatever indecisive trading, if it starts backing off the next day, take your profits immediately. Is this the absolute top? Not necessarily, but what it does reflect is that when you're in a strong uptrend and you see a gap up, there's our hanging man type signal, starts selling off. That's probably, unless they do a complete J-hook pattern, that's probably the maximum or the majority of your price move. Now, if it did a clean J-hook pattern, you could always buy back, but in this case, it failed up here and turned right around. So selling right in here, you basically got the majority of that move, unless it broke out to the upside on another strong price move. But that's exactly what the Japanese rice traders have indicated to us, that when we start seeing these sell signals in the overbought condition, it's time to take profits, especially when they gap up. Notice the exuberance that started coming into this price move as the trajectory started heading straight up. Are these moving averages just on daily charts? No, they work just as well on the 1-minute chart, the 5-minute chart, 60-minute chart. They work on all time frames. Remember, candlestick signals are the accumulative knowledge of everybody buying and selling during a particular time frame, and that time frame does not have to be a set time frame. I traded the E-minis extremely successfully using the 1-minute, 3-minute, 10-minute chart combination. I trade cattle and soybeans off the 1-minute, 5-minute, 10-minute chart combination. I trade the dollar off the 10-minute, hourly, and daily chart combination. A J-hook pattern, who we'll get to, but a J-hook pattern is a strong price move, a pullback where you can see there's indecisive trading, and then he turn it around and do kind of a J-hook and start the next leg up. Chan, I'll see if I can find one as we go through here. If we see a gap up near the overbought conditions, even though we know where our projected target might be, the signal is your primary indicator. They open it lower the next day, you get out of the position immediately. The signal is the number one primary indicator. Yes, these signals or these slides will be available. All right, the next chart pattern is once we see a signal in the overbought area and they gap it down the next day, that's telling you exactly what we want to know. Because after indecisive trading up here, when they gap it down, there's probably going to be more downside. There's been a change of investor sentiment. In this case, what's the gap down telling us? Number one, that they aren't holding on to the T-line anymore, and that's telling us that there's going to be a force to the downside. There's that Doji Gap up. Might not be the absolute top, but it tells me I need to start watching for a sell signal. I've got a little Doji shooting star Harami. Is that a sell signal? Well, when they gap it down the next day, that tells me exactly what, George, I hope you've got a letter from your mother, sister, poker partners. But if you see a candlestick sell signal, overbought condition, and they're gapping it down, that's telling you what force is taking control. You want to be out of that position. What if they gap it up the next day and it pulls back? If you're already, meaning after they've gapped it down, I mean, what if? We could make up all sorts of what ifs. We're just doing what the charts are basically telling us. So the Doji, they take notice day, yes. If they gap it up in the overbought condition, if they had opened this lower the next day, what would we be doing? We'd be closing out the position immediately. You may have taken off half your position here with the simple analysis of if it continues higher from here, we're in an overbought condition, we're starting to see potential sell signals after gapping up. Take profits on half the position. We're still making money on the other half that's continuing up, but we're in a high-risk situation now in half our position versus a full position. But it should also tell you that if we're starting to see indecisive trading up here, start watching for the bears to start taking control. Excuse me again. This is... All right. Uptrend, uptrend, uptrend. Doji, gap down. Get out of the position immediately, because if the observation is that they couldn't get this below the T-line from all the way down here, when they do a Doji gap down, that tells you there's a new investor sentiment. You want to be out of that position as quick as possible, and possibly even going short at that time. Yeah, you were speaking of exits. Yes, you've also got that opportunity that if it's a gap down and you're closing out long positions, you also should, on a gap down, look to see where it might be time to get in on a short position also. Up in the overbought condition, what does this tell you? Start watching for sell signals. A Doji followed by a gap down. What does that gap down tell you? They've made their decision of which way they want to go, and they want to do it with great force. So it's time to be out of that position. So the questions are sliding by here, so if I miss your question, don't worry about it. When we get done, I'll stay on as long as people have questions. But the reason I'm going to readdress the purpose of gaps is gaps and candlestick signals. That combination, just common sense, tells you if there's indecision up here after they've gapped it up and they gap it down, that gives us at least a very clear visual advantage of whether it's time to sell or not. There might be other people that are hoping that it's still going up, but we can tell with the force after a candlestick signal that there's probably much more downside. If you see a gap up in indecisive trading, again, you can always start taking off half your position or a third of position. But if they gap it down the next day, you don't have any other decision other than get out immediately. In this case, this is called an abandoned baby. That's one of your strongest reversal signals. Now, why do you get out immediately? Because over 400 years, the Japanese rice traders have done the what do I want to say, computer analysis, but they've all done it on visual and actual trading basis, that this is what you need to do if you see this type of setup. Because of the percentages or the probabilities, that if you see this reversal, especially in an overbought condition, the probabilities are extremely strong that it's time to be out of that position. Now, I say Japanese rice traders are computer analysis. The Japanese rice traders weren't the ones that use this technique, didn't become wealthy. They became legendarily wealthy. And it's because they use the same basic information year after year, decade after decade, century after century, which is that investor sentiment is going to act the same way time after time. All they did was graphically depict what was going on in investor sentiment and taking advantage of it. Through the years, I would ask people, why isn't everybody using candlestick signals? And the answer was always there was too many of them to learn and they didn't always work. And what kept me learning candlestick signals, even when there was nobody else around to learn from or to compare notes, my reason for staying with it was that if it didn't work, we wouldn't be looking at them 400 years later. The one truism of Wall Street is if something doesn't work, it's gone immediately or very quickly. And Japanese candlesticks have been around for 400 years. So it's not a case of whether they work or not. They work or they wouldn't be around. We just have to figure out how to use them appropriately. Again, there's that doji followed by a gap down. And then with a close below the T-line, that tells you you've got a high probability you want to be going short at that point. Doji in the overbought condition followed by a gap down. Just get out of that position. When you see a gap up, it's time to start watching for a sell signal. A sell signal followed by a gap down. That's almost like an abandoned baby. But you can tell that was the end of that uptrend. All right, this signal right here is what we call the belt hold, bearish belt hold. By itself, it doesn't tell us anything. It may have just told us there was some profit taking, but more than likely it could be a sell signal. However, they didn't close below the T-line. But when you add a gap down and a close below the T-line, that tells you this was a sell signal, and you probably want to be out of this until you see a buy signal and a close back up above the T-line. I can see down here that they couldn't get it back up above the T-line, and they rolled it over again for more downside. Bearish engulfing, gap down through the T-line. Just a high probability you want to be short. A bullish kind of day, but no signal. Opens lower, comes back up, really doesn't do anything. Then they gap it down back below the previous low. Doesn't look like a gap, but it's definitely, they gapped it from here to here. You want to be going short. Whoops. Doji, right at a resistance level, and a gap down. If I see a gap down after a doji and a close below the T-line, those are going to be the primary short situations. Because after a day of indecision, right at a resistance level, if they're gapping it down, that tells you somebody made a decision up here to get out as fast as possible. If you see resistance at one of the major moving averages, such as the 200-day moving average, that tells you immediately they aren't going through. And when they gap it down, it probably tells you they're not going to even support here at the 50. There's going to be a lot more downside. That gap is that force. Let's see, an abandoned baby. All right. I can see we're getting way off course here. All right. The other side is, when do we grab for the falling knife? And that's what the biggest problem for most investors are, is something's going down. When do I buy? Well, the Japanese rice traders have built the flags in for us for doing that. If we see a downtrend, and they gap it down in the oversold condition, what do you think that essentially is? That's that panic selling at the bottom. Now, I've put this gap in here because this is a very simple long-term investing program. I say long-term. Long-term, in my case, is anywhere above 4 to 16 weeks. If you see something like an IBM or a Dell or something that's been in a downtrend and they gap it down, pretty much statistics will tell us that somewhere between 4 and 16 weeks, they'll come back up and fill this gap. So if this is a 20% move, and you can own IBM and in 8 weeks make 20% on it, that's not a high risk or something that will keep you up at night. If you can turn big moves like that over 4, 5, 6 times a year, that compound effect is much greater than just trying to play the market moves. Gap down in an oversold condition, start watching for buy signals. That gap down tells you the exhaustion or the panic is in there. Now, this was easy for me because this is usually where I would be selling because I couldn't stand the pain anymore. And it took me a while to not be in something that was going in this direction that I eventually would be able to have the cash ready down here to be a buyer. The hardest thing to do is buy at the bottom, because what are you listening to on all the news stations? How bad things are. And it's going against the grain when everything is so terrible, everybody's panic selling, to step in and start buying. But for years, I would always think to myself, when I'm selling down here, who the heck is buying? And it usually turned out to be the smart money that was buying right there at the bottom, taking my stock and doing it. So here again, if you see a gap down, you might not see a buy signal that day, but there's the next day, a bullish harami, and they gap it back up. Where's your next likely target? Either the 50 or the 200. And as you can see on this chart, seeing the buy and sell signals right on major moving averages makes it a very easy format to tell you when to be in and out of positions. Nice thing about the colors of a candlestick signal versus a bar chart is when they gap this down, what was it telling us immediately? It's telling us the bulls are stepping right back in. So if I was short and saw a gap down and hoping they were really going to crater it and saw this, that would tell me a completely different story. I'd be covering the position as I saw that candle keep turning green. Now here's the one where you're going to make most of your money. And that's that gap up from a candlestick buy signal in the oversold condition. That's what we call your best friend. Because anytime you see that oversold signal followed by a gap up, especially coming up through the T line, that's where you're going to make your money. That's if just using candlestick signals and gap ups in the oversold area, you can make a fortune just on that one trade signal by itself. Bullish engulfing followed by a gap up. Next day it closes up above the T line. Nice steady uptrend until when? Until you see that gap up in the overbought condition. What should you be looking for then? Should start looking for a sell signal. Now, the only difference of a bottom versus a gap out, there's going to be plenty of times, and this will probably be our next session on gaps, is notice what we have here. It's kind of that J-hook pattern. A J-hook pattern is when you have a strong uptrend that pulls back, indecisive trading, and does the J-hook. Where's our one of our confirmation levels on a J-hook pattern. It's at the recent high. So if they can come up through that level, that tells us the bulls are back. We should be expecting more uptrend. And if they can gap it up through any level that looks like it's a resistance level, everybody and their brother could see there was a resistance level, yet they were gapping it up through that level, not because it was exuberance at the top. It's because they were still buying, knowing they're going through a resistance level. That kind of confirms our J-hook pattern, and we can tell how much further that one's going to be heading up. A bullish engulfing signal, a resistance level, and they gap it up the next day, you want to be a buyer. Now, on a doji day, it makes it very simple. We have a simple rule about a doji. They're going to move it in the direction of how they open it after a doji. In this case, they opened it and did a doji. Next day, they took it up. That told us they weren't selling it off, that you were probably in a very nice uptrend. The reason I showed this one was I had a friend say, my wife says we need to buy this. You know, it turned out to be because it was Kramer recommended it as a buy up here. Nice up move, stochastics in the overbought area, they gap it up. That was probably the end of this uptrend. A doji followed by a gap up is your best friend. And then here's a case. Even though you have a big dark candle here, what happened on the open? They gapped it up. Somebody was buying this enthusiastically. Somebody was taking profits. Next day, want to see the profit taking's over. This still makes for a very strong price move because they've gapped it up and they've gapped it up, and now the profit taking's over. They're probably going to move that one higher. Inverted hammer, spinning top, gap up through the T-line, stayed above the T-line. This one you continue to hold as long as it stays above the T-line. This is your best friend right here. Doji, followed by a gap up, stochastics in the oversold area. Now, we have kind of a formula, not a formula, but some rules that we use for the T-line. Oops, hang on for 1 second, please. Sorry about that. Remember, we said if you see a candlestick buy signal and a close above the T-line, that's when you buy. However, look what happened here. We have a doji. Next thing it opens positive, and the T-line's way up here. So what's the worst case scenario? Worst case scenario is we still buy based on the candlestick buy signal. Now, instead of the T-line becoming a factor for when we buy, it becomes the first factor for what we watch for as resistance. If it came up here and then the next day it sold off, what could we assume about the T-line? That it was still acting as a resistance level. At least we're out probably with a profit. However, oversold condition, a doji a good distance away from the T-line, opens positive. At least we know we've got running room to get up to the T-line to make a profit. And then if this is a confirmed buy signal, they're going to take it higher. The T stands for trigger. It's our trigger line. Kevin, it's still with me. I can't drink enough scotch to get rid of this cold. Where do most people sell? They panic sell at the bottom. There's our first signal that tells us the selling has stopped. What do we want to see after that? A gap up. That not only tells us the selling has stopped, but anytime we see any candlestick signal in the oversold condition and they gap up after that, you're going to get a good price move from it. And I say good price move. Your price move is probably going to be a lot stronger than just a regular uptrending stock. And in the case of markets where you may only have a limited time to make profits, we definitely want to find the ones that are going to have the good fast price moves so we can put those in our pocket before the market decides it wants to change direction on us. Gap up through the T-line, you start buying as long as it stays above the T-line. This is your best friend. A gap up following a doji friend. You'll make money with it. And what you will find is that there is an inordinate amount of times where if you see flat trading and see a doji at the end, get ready to see which way they're going to gap it, because when they do, it's going to be coming out of this flat indecisive trading with some vigor. Yes, this webinar is being recorded, so it'll be available. And here's another case where you've got that hidden gap up. They've gapped it up after getting to the T-line, up to the 20, and it pulls back. That pullback kind of, I want to say, not scares people, but gets them a little bit discouraged. Got to remember, there was enthusiasm enough to gap this up before the profit taking stepped in. The next day, if you see that profit taking is over, that they're moving this up, you buy immediately, because that usually tells us when this profit taking is over, the force of these gap ups are going to continue in the uptrend. A gap up from a doji is your best friend. Anytime I see a doji gap up, a lot of people say, well, I don't want to buy a stock that's already up 3, 7, 15, 20, 40, 80%. You do if it's coming off a pattern or a signal, because you don't know if there's not another 200, 400, 600% move after that. And, all right, let's see. Whoops. Anytime I see this gap down, notice how this rolled over and started just getting enthusiastically sold. Then they gapped it down. If I was short, this would be very simple. If this opened here and started trading down here after gapping down, I'm putting a stop somewhere in here. And it might be right where it opened. And if it continued down, that's fine and dandy. If it went down and came back up through where it opened, I'll get out there because I've already been prepped. They've gapped this down in an oversold condition. Start watching for a buy signal. Why does the market not come back to fill that gap? They do. Most gaps get filled. They may not get filled this week. They may not get filled this month. They may not get filled this year. But they eventually, prices do come back and fill an area. But I'm not worried about, in this case, I wouldn't be worried, but let's see. In this case, the question is, why doesn't it come back and fill? Because I'm not worried about what it does over here. I'm playing this trend, or I'm playing whatever move is based off of this signal. It might be 5 more months before they bring it back down and fill this gap, but it might not have anything to do with this trend. Is there a minimum size of a gap? Not really. If you see a candlestick buy signal and a gap, it tells you immediately that the buyers have stepped in right after that indecisive signal. So here we got 2 different gaps. We've got a gap up above the T-line. We want to start buying. Now, do we want to buy a gap in an overbought condition? Well, that usually tells us that we've got exhaustion. However, if you can see, what everybody else can see is that they gapped through. That wasn't exhaustion. That was telling you there was enough force that even though they knew there was a resistance level here, they were going right through it. That meant there was still more upside to that trade. Excuse me. Let's see. We did this. The gap's up to the upside. Oops. We might have some repeats in here. Why do we get repeats? Oh, because we just kind of want to review this. Again, what are most people's thoughts when they've got an uptrend, and bang, they take it up? boy, oh boy, I kept thinking how rich I'm going to be because that's gapping up. It's going to go way up. I learned very quickly that once they gap this up, especially in an overbought condition, start watching for a place to start taking profits. At least take half the position off, because now you're in a high probability or a high risk area because you're in an overbought condition and you've gapped up. It's time to take some profits or take some of it out of the market. Again, a gap up. Did we just look at this? No. Again, it's telling us. That's why we know what the signals tell us. Notice the dojis up here. If this was a gap up and it was going up, we wouldn't be seeing dojis. What it's telling us is we're too far away from the T line. It's going to come back and test the T line. So start taking profits. What most of our fear is, or one of our fear is, which is one of the chapters that I address in the third book of trying to get rid of your emotions out of trading, is what's my biggest fear was, man, I finally got a good trade and it's going positive. This is going to be the one that buys my new car, my new boat, my new house. I'm thinking how far it's going to go up instead of watching to see what it's actually doing, or what common sense tells us that when they gap it up in the overbought, it's time to take profits. So I have a hard time selling here because my fear is I sell here and it just keeps going up. Boy, would I look stupid. Well, with the ability to see what type of investor sentiment is going on with candlesticks, if it started going back up, it was telling me a different story. I could always buy back in. But the probabilities say it's going to come back down for a while before you want to get back in again. All right. Again, the gap down is time to start to not only be out of a position, but start taking profits. Anytime I see a doji, especially right on a T-line, and they take it in this direction, especially gap it in this direction, I'm ready to go short. Bearish engulfing, gapping down. This is one of your most bestest setups where once they come below the T-line and you can see they can't get up above the T-line, they're going to break it down. And that's, remember, there's not that many decisions when it comes to selling as there is buying. When you buy, first of all, you got to figure out where the money's going to come from, how much you want to buy. What market do you want to, or what account do you want to put it in? All sorts of decisions. When it comes time to sell, you only have one decision, and that's just sell. And that's why it's done so much faster than the buy decisions. Okay. Again, that gap down, Doji gap down. Let's see. Let's get to a few new ones here. If I see a trend channel and they gap it down through that, that tells me there's a whole new dynamic in that trend. I want to be short. If I see a sell signal and they gap it down through the T-line, that tells me the force is going to take it down to the next support level, at least, probably down here to the 200-day moving average. Now, I say probably. If I saw buy signals in here, I'm going to base my trade of being in and out of a trade based upon the candlestick signals, not what my projected targets were. Those are just where I think things can go. The signals tell me exactly what's going on in those situations. We did that. So here's part of the psychology of knowing what to do with the graphics of candlesticks. Fry pan, what do we expect out of a fry pan bottom? Expect that strong uptrend. You're in an overbought condition. What's the last thing that we should see if we're in an uptrend? But the bears are able to gap it down and open it below the previous day's open. That tells me they've now gotten control. That's time to be out of that position. Here's a very simple short entry. See a doji sitting right on the T line. Which way is it going to go? It's basically going to go in the direction of how they open it after that doji. And if it's sitting on the T line, if it opens positive, we can make the assumption they supported the T line. If it opens negative, we can assume they're not supporting of the T line. There's still more downside. And if we see them trading down and then gapping it down, that tells you there's going to be a lot more force to the downside. All right, here in the last couple of days, these came from the, I think Kunar found this one. Camp had a kicker signal, followed through today. This was yesterday that one showed up. American Greetings. The bigger the kicker signal, the higher the probability the uptrend is going to remain in progress. This kicker signal took us right back up to the top of this trading range. With this trajectory, I wouldn't doubt that trajectory isn't going to continue. This told you a big story, that there's going to be a lot of force to the upside. The kicker signal is a gap up, and it's your strongest signal. A doji followed by a gap down today. FUL. If this opens lower tomorrow, you definitely want to be shorting. They could be taking this a lot lower. Or, if you can see that there's a trend, and they start rolling it over, and even somebody says, what size gap? Gap doesn't have to be very big. There's your doji, and they gap it down. That tells you which way they're taking it. They can't take it back up. They're going to be taking it down, and that's usually where you get your big moves to the downside. So, in a nutshell, using candlestick signals tells you what investor sentiment is occurring. Oh, this is great. Excuse me. The gap shows you how much force they're going to go after that investor sentiment has turned. So that's what I've got so far on the PowerPoint. I've got a bunch here that we're going to look at live. But before we do that, Pat wanted me to show you this. We have 2 full trainings of gaps, so that if you need something on hand where you can continue to go through it, we've got the training on gaps, and she's given everybody a special that if you want this so you have it in your files or your library, tonight you can get it for 50% off. So it's like buying both of them for one. So let me see if I can do this. So I think you can get it at that spot. So this is something, that if you're sitting home on a dark, cold, snowy night, and we're not having a chat session, you can pull one of these out and study it and say, all right, the big money's in the gaps. Let me take a look at them again. All right, if you'll hold on for a second, let me go through some of the live charts today. Let's see. Jim, hold on. I'm going to shut this down for a second. Close out this chart and bring over these charts. And whoops. Now I got to get all these charts in place. They'll be right there. Hold on. Here I come. What did I just do? There we go. All right. Okay, now, here's what's going on in the market today. TPX had a nice gap up today. So we know there's been a strong reversal force, and we're in the oversold area. This makes for a perfect entry because we know the simple rule of a doji that if it opens positive tomorrow, you want to be buying immediately. If it opens positive tomorrow and starts trading positive, excuse me, what type of signal do we have in place or setting up? That flutter kicker, which is a very strong reversal. So we know there's going to should be a strong reversal because we've already gapped up. There's been indecisive trading, profit taking. Now, if they open a positive, it tells us who's won the profit taking. So anytime you see these gap ups, get ready to buy, because even though this was up, about 10% today, this could still have a good 20, 30, 40% move to it. Can't see anything? How about everybody else? All right. Now I've lost who was having trouble. Jim, whoever was having trouble, if you can help them. LOGI, Logi. Same scenario. Notice how it gapped up right here to the T-line with a doji. Makes it very simple. If it opens positive tomorrow, you want to be buying immediately because you've got that flutter kicker set up. Anything that has something to do with a gap, in this case, that kicker type signal, you want to, that's where your inordinate profits are going to come from, not just your steady uptrend. That's where the fast uptrends are going to start coming from. TRGS, kicker signal. If it opens positive tomorrow, you want to be a buyer. In this case, because it is a kicker signal, you give it more leeway. You don't want to see it trade back below where it opened down here, because that's where the bulls started taking control. But if it comes back down in here, you're going to have some profit taking, which I wouldn't be concerned about, because this told you there was a definite change of investor sentiment. Flutter kicker signal. This is a kicker signal where you have a down day. The next day they gap it open at or above the previous day's open and go the opposite direction. Well, a flutter kicker signal is even more helpful as far as, now, if we saw this, it might be 10 minutes after the market open, it's already moving up like this, so we're chasing after it. We may not have funds available or everything set up to buy this, but we see it's a kicker signal. We want to get in as fast as possible. To have a more, planned trade, we know in this case we've got a bearish candle. The next day they gapped it up and did a doji. If they open up positive, we know they're probably taking it positive because of the very simple rule of a doji, that they're going to move it in the direction of how they open it after a doji. Which means if they start taking it positive, you can be buying immediately on the open, knowing that they're going to probably take it this way and cause a flutter kicker signal, which is a kicker signal that has a doji in the middle, that if you took out this doji, you'd have a kicker signal set up. What is a positive open? Above the, I would probably say just above the 50-day moving average, just anything positive from where it closed. And that's probably going to, and then if it comes back, if it opens positive, where should it be going? It should be going positive. If it comes back down through this level, you close it back out because that's the direction it should not be going. Do you use the 9:30 a.m. or look at what it's doing in the pre-market? I'll look at what it's doing in the pre-market, and if I see that it's trading up, then I'll be ready with the order as soon as it opens to be buying it on the open. What about entry points following these types of candlesticks? Bill, that'll be for you new folks that are just trying out the site. We used to sell all that material of entry and exit strategies and that sort of thing. But what we found is more effective is instead of selling the material, if you stay a member, instead of paying out $200, $300, $400 each month for material, you're going to get that all free as a member, because we will do sessions on entry and exit strategies or stop losses using candlestick signals, scanning techniques like we're doing tonight, using gaps. One night we may use how to use the patterns effectively. So all that information is much better learned when you hear it live and you can ask questions or see what other people are doing asking questions than just trying to read it or follow it off of a training CD. FSLR, First Solar. Notice it did a doji followed by a gap up today through the T-line. It butted its head on the 200, but if it opens positive, this is still in effect. Not only do you have a pennant formation setting up, but you've now had a doji with a gap up that if they break this through the 200, you're probably going to have some good running room with it. Now, I say probably. This is the prospect of what could happen because you're already setting up for it right here with a doji gap up. That's usually a little bit more force to the upside than just a regular slow uptrend. SGI, I have on here for some reason. Whoops, that's the wrong SGI. There's the same scenario with a doji gap up through the T-line off the 50. Stochastics coming out of the oversold area. Kind of a trend channel here. You might have enough room for this. Even if it came back up to the top of the trend channel, you'd be up over 10%. And if it runs from there, you might have a move like this, which create 20 or 30% to the upside. Let's see. Oops, somebody just... All right, that was the link again on the... And then NICE, kicker type signal coming out of a fry pan bottom. That's enough force to tell us at least look for the 200-day moving average. Again, this is not, this is just taking the information that the Japanese rice traders have provided for us and kind of segregating it into different situations where we can take advantage of that information. Doji off the 20, gap up, J-hook pattern coming out of a fry pan bottom. This could have another 4 or 5 points to the upside. And HL. Little gap up today, a back up above the T-line. This is one of the hard parts of your discipline. Not only when to get out of a trade, but when to get back into a trade. You've got a candlestick buy signal and a close above the T-line. You stay with it until you see a candlestick sell signal and a close below the T-line. Or they start selling it off here. There's nothing wrong with selling here and buying back here. You sold when you knew it was time to get out, and you bought back when it came back up above the T-line for that very simple rule. As long as you're above the T-line, you're in an uptrend. Now, stochastics just kind of tell us where we are in the trend, makes the buy signals and the sell signals that much more credible. CDE, another one that came back nicely. A little piercing signal, right closing right on the T-line. And notice what the T-line did for this trend the whole way up. Didn't have to lose a night's sleep until right here. You close it out. Right here, you buy it back in as long as it stays above the T-line. Now you've got that little J-hook type pattern, scoop type pattern set up. Nothing wrong at all with closing out a position when it's time to close out and buying it back. That's where you get rid of the fear of, man, if I sold here and it went up without me, the signals are going to tell you when it's time to get back in. Which one is this one? SLW, silver, or silver wheaten. Closed out here be ready to buy even on a positive open. If this stock goes up 10 points and I only make 7.5 points, but each time I was in it, I knew the probabilities were in my direction, I'll live with that all day long. What I don't want to be in is some positions that are a positive and some that are negative, offsetting each other. I want to be out of the ones that tell me it's time to be out, and I want to be back in the ones that tell me it's time to be back in. Kicker type signal on Jazz. Hold on for a second. Okay. So you got a kicker signal that may be starting a J-hook pattern. And our J-hook pattern, as we know, if it started around 44 and went to 58, 14 points from here should take us up to 70. So if that's the case, we can either buy the stock, which would be a good percentage move, or we can put on some effective spreads on the way up, because we know what our top side potentials should be. IDCC, gap up, gap up. This one you can be back in. Notice how they've gapped it up a couple times. In this case, not a clear gap, but open higher than where it closed the day before. Telling you there's people anxious to get in, and they're right back to the top of the trend channel, but with a lot of juice left in the stochastics, which tells me this move right here could probably be the same trajectory as this move right here versus this trajectory right here. How do you build scans for gaps? Very simple. That's just off a scan that tells me which stocks have the biggest percent move this morning, and I can see very quickly which ones are gapping up. FST. S.FST. Very mild, but just a slight gap up from the Doji. In an uptrend, you're at the bottom of the trend channel. I'd look for it to come up, back up toward the top of the trend channel, which would be a good percent move. CNX. S.CNX. Gap up. Even though it's not above the previous trading, it's a preferred piece away from the from where it closed the night before. If this one opens positive, you're basically on a bottom of the trend channel. This becomes your next target. At some point, after moving sideways, they're going to break out. So once it gets up here, you just see whether this was the breakout. If not, you made 10% on that trade. And HIG, another gap up Doji. Very simple. If it opens positive, you want to be buying immediately. Bottom of the trend channel could go to the top of the trend channel, which means this could be the big leg coming out of here. Couple on the sell side. CPHD. Sell. Little bullish candle, then a gap down. This tells me there's probably a lot more, especially with your stochastics. Still got a long ways to go to the downside. So it's not difficult to find these trade setups. Oops. S-E-Z-C-H. Notice how this one is slowly rolling over. Doji, kind of a little gap down. This one could be ready to roll over all the way back down to test the lows again. MKC, gap down Doji makes this very simple. If they open this lower tomorrow, you start shorting immediately. Where's your next viable target? Probably down here to the 200-day moving average. And one more win. Whoops. Bearish engulfing signal, gap down. Big hammer, telling you the bulls could be taking control, but they open it lower, which tells you what? The bears are still in control. Stochastics heading down. This one you want to be shorting on any weakness because you've got a bearish signal and a gap down. Tells you the force is going to be going in that direction. Okay. Everything slipped by, so if you had a question that went by, go ahead and ask it again. I'll try to get to it. All right. When a position trades below the T-line on a given day, how much below the T-line do you wait before you exit the trade? Sometimes it goes pretty far down, but reverses and closes above the T-line. How do you determine your stop? If it comes back below the T-line, see if there's a better one. There's one right here. It got whacked in it anyways. But if it comes down below the T-line, notice what this one did. It opened below the previous day's open and started going this way. You can close out the position because what's the worst case scenario? If it comes down here and bounces, you can always buy it back when it comes back up through this level. So anytime I see any selling going on right at the T-line, you can close it out. If it goes below and comes back up through, you can always buy it as it comes back up through. You've eliminated your risk as far as holding on to something that might have continued on the downside. Now, that gets a lot more difficult. That's probably comes with our stop loss training, which we'll probably be doing probably within the next few weeks. Okay, let's see. Oh, Prudential is buying pig. All right. Yeah, let's just keep the questions to gaps. We probably won't have enough time to go through a lot of the stocks. What about price spreads? If it has a big spread, is it still worth getting in? That's a function of where you think the price target is. I don't mind paying an extra 10 cents or something, knowing that I'm going to make $5 with it. So remember, that's just the playing field. So don't let the price deter you from, or the bid-ask spread deter you from staying out of a good position. How do we get the ebook? Which ebook was that on? Let's see. Go to that link at the bottom of the page. Are you able to predict gaps so you can buy or sell early for extra money? Not really. But I'm not trying to predict the gap. I'm not trying to buy at the absolute bottom or sell at the absolute top. I want to buy when the signals tell me it's time to buy, and I can get that fat part in the middle. If I can make sure that my correct trade ratio is a lot stronger with all the fat part in the middle, that's going to compound a heck of a lot better than trying to be less correct with trying to get things closer to the bottom and out closer to the top. With the markets under the T-line, you're still okay buying stocks. No, I'm not. Tomorrow, we need to see this market open higher. Today, all three indexes closed below the T-line, which technically means that if we're still closing below the T-line and our stochastics are heading down, that we're priced still in a downtrend. Now, that could change on tomorrow's trading. But until we get that confirmation, we have to assume right now that we're still in a downtrend. Is a gap because of earnings report any difference? No. Remember, a gap is created by the cumulative knowledge of everybody buying and selling during that particular time frame. And if it was a candlestick or if it was an earnings report that did it, that's fine. The only time I don't pay attention to a signal that was created by something is when somebody upgrades or downgrades a stock. because all that is a short-term difference in supply and demand. The T line is the 8 exponential moving average. Stochastics are 12.33. Is the 8 EMA T line also a Japanese trigger, or where does that technique came? That came from one of my first private training students, Rick Sadler of Hit and Run Candlesticks. He went back to Anchorage after I spent a weekend teaching him candlesticks, and eventually came up with a T line. When he showed me the results of the T line, I mean, it has improved my returns dramatically. It keeps me from getting whipsawed out of quite a few trades. Okay, thanks, Gary. What was the stock, 3 stocks back, beginning with CPHD? System works just as well with the ETFs and the funds. Remember, it's the cumulative knowledge of everybody buying and selling that particular entity, whether it's the total index or whether it's an individual stock. Do you watch the general market, say the S&P, and look for longs when yes, that's the first priority, is using candlestick signals and patterns. You can get a pretty good feel for which direction the market is going. And then you apply your positions to your portfolio based upon whether you think we're going up, going down, or going sideways. Thanks, Albert. Ebook. Which ebook? Do you like longs better, shorts better than longs with market under? Yes. If the market is under the 8 EMA, I would have more short positions on than longs. And that's, again, the nice thing about candlestick analysis is the scanning techniques. You can come up with the best 3, 4, 5 long positions in the market and the 3 best short positions in the market. So today's portfolio might be 7 positions short and 3 positions long. If we know if tomorrow it starts selling off, we might close out 1 or 2 of the long positions and add short positions. So you get a much more clear evaluation of what the market's doing based upon the candlestick charts. What option strategies would you employ after a Doji Gap down? Depends on how long we think the market's heading down. There's always the short. I prefer spreads versus outright calls, but that's a whole different session. We do a whole session on option strategies. Not so much new option strategies, of which option strategies to put on particular candlestick signals or patterns. Yes, this is, I used to trade the E-minis using the 1 minute, 3 minute, and 10 minute charts. I trade commodities right now on the 1 minute, 5 minute, 10 minute chart combination. Do you watch the general market? Yeah, we did that one. Are you using other indicators in conjunction with candlesticks? Whatever adds to the credibility or the confirmation that there is a reversal going on. My number 1 criteria is, what is the candlestick signals telling me, and why is it turning here? Is it Fibonacci numbers? Is it trend lines? Is it moving averages? What else is happening here that somebody else is looking at that would confirm that the reversal signal should be going on at this point? Would you do leap options for gaps? I don't know. Don't have an answer for that. Is there a certain amount of days to stay? Not a number of days. You stay in as long as you don't see a sell signal. No problem, Mike. I'm happy to do it. Oh, shoot, Donna. Maybe you gave it to me. Slow stochastics. Can you say something about determining targets? Yes. Where's the target? All depends on how strong your sell signal is and how far away the target is and where your stochastics are. Now, in this case, I would think the 50 is probably a viable target, but probably too close. I would think that with stochastics still with a long range down, that down here is probably your target. So it's a function of how much room do you have in your stochastics, how strong is the buy or sell signal, and how far away are potential targets that everybody else would be watching. That's right, Paul. Let's see. I really can't quantify them, except I will be putting out a CD to quantify. But the kicker signal is your number one. It doesn't matter where it occurs in a trend. If you see a kicker signal, that means there's been a definite change of investor sentiment. But then there's the Doji Gap up, which I put very high on the list, as well as any of the other signals in a gap up, especially coming out of an oversold area. But then you also have situations like J-hook patterns, cradle patterns, fry pan bottoms. If they are breaking out, your probabilities are extremely high. You're going to make money with those. So I am going to do kind of a quantitative one where I put on maybe the 18 best buy and sell signals. So at least there's kind of a ladder of which ones to be looking for. Of all the candlestick signals, we did that. All right. With an exhaustion gap down that ends a downward trend and you get a reversal signal of a hammer with a long shadow, do you ever buy over the hammer bar and wait until it closes above the T line? Again, that's still a function of how far away it is from the T line. If it's a good distance away from the T line, I'm buying as soon as the hammer signal is confirmed. If it's occurring right at the T line, then I'll wait for it to come up through the T line. Stochastic settings at 12.33. I'm going through these fairly quickly now. 8 is a Fibonacci sequence. I probably need to drink heavier antibiotics. Do you trade options or stocks itself? Does it really matter? No, it'll be a function of whether I think the options have, if the upside gain is good, but the downside risk might be greater, I might go with an option versus a stock, so that my loss will be limited. Please confirm that you said you don't buy if overall. No, I'll say my majority of my trades I'll probably be oriented toward the downside if the market is below the T line. That doesn't necessarily mean I stay out of all long positions, because there are going to be long positions that we can find very easily on a down day. Like HCA did a nice J-hook pattern today. This I wouldn't be afraid of owning on a positive trading tomorrow, no matter what the market's doing, because the pattern is stronger than what the market itself is doing. If the price is closed above the T line, are we looking for buy? Yes. Do you use ATR to buy or sell ATR? ATR, I don't know what ATR is. What time frame do you use for the T line? That's the 8 exponential moving average. Do you concern yourself with wash rules? No. It has nothing to do with the trade. Wash rules are tax considerations. Let's see. Yeah, the cold's been with me for 2 weeks now, so I'm getting used to it. When I feel like I have a fever, I just jump in the pool and I feel better again. Stochastic settings 1233. I do trade vertical spreads. Let's see what else we got. All right, I guess we'll. How about using pivot points? I don't use pivot points all that much. Now I know my friend John Persons is good at pivot points. I just haven't used them. I've never had to. I'm making good money the way it is. What is the definition of a kicker signal? A kicker signal is when. What was our kicker signal? Camp. Kicker signal is when it opens here and closes here. Then the next day they gap it above the previous day's open and go the opposite direction. That's a kicker signal. Investor sentiment has been kicked in the opposite direction. I have the link. It doesn't describe what you are actually selling. I don't know what that means. What about abandoned babies? Those are the strongest, again, strong reversals, yes. It's like a one-day island reversal. It doesn't matter which one. The stochastics, all I want to know is whether I'm in an overbought or oversold condition. One line would probably be as effective as two lines. Okay. Let's call it a night. What is a flutter kicker? I didn't think we went through that one again. Oh man, way down here. Yeah, and that's also true that if we think the market's staying below the T line, if you have any long positions, you move your stops up to make sure that your long positions aren't coming down through areas they shouldn't be. Okay, I guess we'll call it a night. Still kept everybody over time. We'll see everybody in the chat room tomorrow. Okay, you didn't hear the definition of a flutter kicker. Which one was the flutter kicker? Was it IDCC? No. I'm going to get it here. Here's a flutter kicker right here. It's where you have a dark candle. The next day they do a doji where they gapped it up above the previous day's open. So it closed here, they gapped it up here above the open, but did a doji. And we know the rule of the doji, that if it's going to move in the direction of how they open it as a doji, or after a doji. So if they open up positive, you're buying immediately because you know they're probably going to move it positive. Well, if they do that, and you took out the doji, you'd have a dark candle and then a gap up bullish candle, or you'd have a kicker signal. You have a flutter kicker signal when that doji is in between. Okay. Well, thank you, everybody. I'll go jump in the pool, and I'll throw coins in there for my birthday and see if I can find them. All right, everybody, have a good evening. We'll see you in the chat rooms.